When it comes to building wealth and securing your financial future, few decisions are as impactful as where you consistently invest your money. Many people hear conflicting advice. Some swear by the stock market. Others emphasize the importance of insurance-based strategies like term life or whole life policies. To cut through the noise, I decided to explore a simple but powerful question. What would happen if you invested $500 every single month into three different financial paths? Stocks, term life with investing the difference, and whole life insurance. The results are not only surprising, but they also reveal deeper truths about risk, growth, protection, and long-term financial strategy. Today, we will talk about I invested $500 per month. Stocks versus term versus whole life. Shocking results. So, before we start, make sure to hit the like button and subscribe to my channel. Let's begin with the stock market approach, often considered the gold standard for long-term wealth creation. Investing $500 per month into a diversified portfolio, such as index funds or ETFs, historically yields an average return of about 7% to 10% annually after inflation. Over a 30-year period, this consistent investment can grow into a substantial amount. At an 8% annual return, for example, your total investment of $180,000 could grow to roughly $750,000 or more. The power of compounding plays a huge role here, as your returns begin generating their own returns over time, creating exponential growth rather than linear progress. Another important aspect of stock investing is diversification. By spreading your investments across different sectors, industries, and geographic regions, you reduce the risk of any single failure wiping out your portfolio. Many successful investors rely on low-cost index funds because they provide broad market exposure with minimal effort. However, the challenge with stocks lies in emotional discipline. Market crashes, like those seen during financial crises, can wipe out years of gains temporarily. Investors who panic and sell during downturns often lock in losses, while those who stay invested tend to recover and grow even stronger over time. Now, let's consider the term life insurance strategy combined with investing the difference. Term life insurance itself is relatively inexpensive, especially if purchased at a young age. For example, a healthy individual might pay $30 to $50 per month for a substantial death benefit. That leaves approximately $450 to $470 each month available for investment in the stock market. Over time, this approach can closely mirror or even match the pure stock investment strategy, depending on fees, discipline, and consistency. The advantage here is twofold. You gain financial protection for your family while still benefiting from market growth. If something unexpected happens, your loved ones are financially secure. Meanwhile, your investment account continues to grow independently. This hybrid approach is often recommended by financial advisors because it balances risk and reward effectively. However, term life insurance has a major limitation. It expires. If you outlive the term, which is the most likely outcome, you receive no payout. At that point, you are left solely with your investments. Additionally, as you age, renewing or purchasing new term coverage becomes significantly more expensive. This means that your long-term protection is not guaranteed unless you plan carefully and build sufficient wealth through your investments. Now let's dive deeper into whole life insurance, one of the most debated financial products in personal finance. Whole life insurance combines a death benefit with a cash value component that grows over time. When you invest $500 per month into a whole life policy, a portion goes toward insurance costs, fees, and commissions, while the rest builds cash value. This cash value grows at a guaranteed rate, often supplemented by dividends depending on the insurer's financial performance. Over a 30-year period, your cash value might grow to approximately $300,000 to $400,000, which is significantly lower than stock market projections. However, what makes whole life unique is its predictability. You are not exposed to market crashes, economic downturns, or sudden losses. Your growth is steady, consistent, and backed by the insurance company's guarantees. One of the most powerful features of whole life insurance is its financial flexibility. Policyholders can borrow against their cash value without triggering taxes, which can be extremely useful in times of need. For example, You could use policy loans to fund a business, pay for education, cover emergencies, or even supplement retirement income. Unlike traditional loans, there are no strict repayment schedules, giving you greater control over your finances. Another often overlooked benefit is estate planning. Whole life insurance ensures that your beneficiaries receive a tax-free death benefit, which can help cover estate taxes, debts, or provide long-term financial support. For individuals looking to leave a legacy or create generational wealth, this feature can be incredibly valuable. But here's where things get truly shocking. When comparing these three strategies side by side, the best option isn't always the one with the highest projected returns. Stocks clearly win in terms of raw growth potential, but they require emotional resilience and long-term commitment. Term life combined with investing the difference offers a balanced approach with strong growth and protection, if executed properly. Whole life, while lagging in returns, provides unmatched stability, guarantees, and strategic advantages that are often underestimated. Another critical factor is behavior. Financial success is not just about numbers, it's about consistency. Many investors start strong but lose discipline over time. They stop investing, withdraw funds early, or make impulsive decisions during market volatility. Whole life insurance, on the other hand, enforces a structured savings habit. This forced discipline can actually lead to better long-term outcomes for individuals who struggle with managing their finances. Tax treatment also plays a significant role in long-term results. Stock investments are subject to capital gains taxes when sold, and dividends may be taxed annually. Over decades, these taxes can reduce your overall returns. Whole life insurance offers tax-deferred growth and tax-free access through policy loans if managed correctly. This can make a meaningful difference, especially for high-income individuals looking for tax-efficient strategies. You should also consider your life stage when choosing a strategy. Younger individuals with fewer responsibilities and a longer time horizon may benefit from aggressive stock investing. Families with dependents may prioritize term life insurance for protection. Meanwhile, individuals nearing retirement might value the stability and guaranteed nature of whole life policies. Ultimately, the biggest lesson from this experiment is that personal finance is not one size fits all. The best strategy is the one that aligns with your goals, risk tolerance, and ability to stay consistent over time. In many cases, combining all three approaches, stocks for growth, term life for protection, and whole life for stability, can provide a well-rounded financial plan. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.